Good morning, everybody. Welcome to the Flow Show, Thursday, 17th of July. another bonkers day in trading yesterday. Left it till late in our day anyway, but Carnage ensued. Morning, Kay. Surviving?
Good morning, Ryan. Yeah. Actually, doing better than surviving, thanks to our party. There must be something going on there because I think Trump has put his hat in the ring to get the Nobel Party Prize for having Independence Day every day for 4 years in the U.S. But he actually saved my day yesterday, I must say, which is normally very surprising.
Yeah. Good to hear he saved your day. He certainly made my day yesterday as well. So, yeah. Hopefully, a few of you made some pips on the back of that as well. But, still very dangerous volatility when you get things like that happening, which we shall talk all about shortly. Let's get through some of the other headlines, bits and bobs first. But before we do that, don't forget to sign up for our newsletter to keep you informed of what's going on at ForexAnalytix. Anyone who signs up for this, we are looking to run a webinar in August on risk management, in which all the team will be participating, and you'll only be able to get access to that if you're on the Trading Analytics list. So it's not going out publicly, it's not going out on YouTube. The only way you'll get access to that is by being on that list. So make sure you join it so you can get front row seats to that webinar. I'm looking forward to it. And talking about risk management is something we always like to talk about here. And yesterday was a perfect case of why you need it as well. Right, let's crack on. Japan's Cabinet Secretary Akazawa, the guy in charge of most of the trade talks, held in-depth talks with Lutnick on tariffs. We're also expecting Besant to turn up in Japan for this expo. And apparently Japanese press are saying that he's going to pay a courtesy visit to PM Ishiba. He's long maintained that he's not there for trade talks, but good luck not talking about trade once he meets Ishiba. So we've still got some potential stuff to go on there. Kay, is it he's going there for Friday, I believe, so we should get any headlines overnight or early in the morning our time to be able to react to them.
Yes, I don't know his exact schedule, but I guess going to the expo, if you pay a courtesy visit to Ishiba and then going to the expo, is probably going to be there for the weekend or so. Yeah, it's been repeated from the US side that it is not a visit to talk about trade, although the Japanese are obviously dying to be able to talk about trade and to find some sort of an agreement. But that Akazawa call with Lutnick didn't give anything at all. So the prospect of reaching any or making any progress is looking quite bleak, I'd say.
Yeah, it makes you wonder why he's going to the expo at all, but maybe he's like the rest of us and just after a few free umbrellas, mugs, pens and stress balls, which you
And air miles.
And air miles, of course. Yeah, mustn't get the old air miles. Moving on to currency news, shall we say. Japan's Aoki said currency moves should reflect fundamentals, be stable, and to ensure stable JGB issuance conditions. We haven't had a bit of jawboning out of Japan for a while. Okay, I mean, these moves are up and down like proverbial horse draws, but someone felt the need to come out and talk about it, but we're not in any sort of intervention territory right now, are we?
Nah, no, we're not. No, we're not. We were talking about it earlier, and really, my view is that if there has to be done something, well, the elections are a risk a risk point, of course, and the talks, the ongoing talks, or the lack of. So I guess the Bank of Japan is standing ready early next week to not, I don't think, unless we see dollar yen all of a sudden trade 150, 123 after the elections, but I don't think that they are ready for FX interventions. But more, I would more look at it on the JGB side of things.
Yeah.
If we see that long and ultra long end collapse after the election results, if it would really be messy, then I guess they will somewhere step in. We can just compare it with what the Bank of England has been doing in 2022. Where they also say that they stand ready to do something on the gilt side if things get out of hands. It's more on that front, I think, that they are standing ready right now. Obviously, we know speed of moves, etc., amplitude. Kuroda gave us that 300 pips a day is too much for several sessions. Um, Maybe we can still keep that in mind if dollar yen would start to fly, obviously. Um, right now, right here and now, I would rather say it's on the JGB side that they stand more ready than FX, let's say.
Yeah, absolutely. That's exactly what I was going to say as well. Because you do need to know what the risk is into this weekend, and the political risk is more on can they pass law, can finance bills and everything else that goes on if there's problems in the upper house. So that will be more reflected in bond markets more than the currency. The currency will be a follower rather than a leader in anything that happens. So yeah, if they pull out the old unscheduled bond buying, don't be surprised. We've warned you all where it's likely to come from. Right, moving on. We had some data out from Aussie, down underland, jobs numbers, and not looking too good. Jobs, employment change coming in at 2K versus an expected 21K, so very soft. There was a complete flip around on the full-time, part-time numbers of full-time employment coming in down 38.2, pretty much wiping out the gain last month, and similar for part-time going the other way. We saw the unemployment rate rising to 4.3%. Now, there was a tick up in the participation rate as well. So some of that, not all, some of that jump in the unemployment rate would be down to that participation rate. But we're still 2 pips up over what was expected and last month as well. It was still a jobs gain, Kay. It's not a disastrous report in any way, shape, or form. But the market's taken that as a clue that well, they're going to be cutting at their next meeting. Is it a big certainty as that?
I think there's a bit of positioning in there, Ryan. Aussie was holding pretty well. I guess some people trading against that 65 level, but as we usually say here, don't only look at the dollar side of things. Just look at the crosses as well. And Aussie was doing pretty well on the crosses, and I think it has maybe even more to do with the cross side than the dollar side. This move, and obviously it's going to weigh on the Aussie dollar in a way. But yeah, as you can see, Aussie yen lower, Aussie Kiwi lower, Euro Aussie quite a bit higher. Back through that 179 zone. And I think that's where we have to find what has really happened. I think even more on the crosses than the dollar, and the dollar, as the dollar side of things as caught up with the rest of the dollars, because Aussie was doing a bit better than other dollar pairs. So it is a, even if it's a small job creation, the market is looking at that unemployment rate and saying like, well, uh, 0.2 higher, it's a bit of a jump. Um, and also, as we've been talking, and we see that in the Canadian jobs report as well, when we get that full-time, part-time balance, that's probably what told the market to get out of some of its Aussie, if the Aussie positions were long at least, or adding to some shorts, because that balance is not very healthy, right? So I think that's where it is, and maybe a bit of hopium as well that since the RBA kept the rate still a decent report could have comforted that position. But now, obviously, with a jobs report which comes in weaker, there is a bit of a risk come the what is it, August meeting? Yeah, August. I think
Yeah.
in a small month. I have just my sheet around here. Yeah, 12th of August. So yeah, that probably opens the door to a bit more um, risk pricing in for a move then.
Yeah, it's I'm not going to say no, they're not going to cut based on this chart I've just got on the screen, but this unemployment rate is still very, very low historically, and that there's some context to that as well. Obviously, the central bank is going to react on how unemployment moves as much as what the level is, but if you look at that chart, that chart doesn't scream they need to be cutting tomorrow. So I'm not saying they won't cut. As I say, they've got to act on the economy now and how it looks, not how it was 20 years ago. But the jobs market isn't collapsing. It's a bit like the US. It's not collapsing, maybe seeing a bit of weakness. Is that enough, though, to get them cutting? We shall wait and see. Right, we also got UK jobs for what those numbers are worth these days. And again, looking, you could pick the bones out of this one and say it was another, sort of weaker number. We saw, the claimant count coming in just under 26,000. So that's still a pretty high number. Payrolled employees, which is the one that I don't think it's actually on this thing. No, it's not. Payrolled employees, that's the one that took a bit of a dive, dropping roughly 110,000 last month. That came in minus 41,000. However, last month's minus 110,000 got revised to minus 25,000. So a big, huge revision there. Pretty much 80,000 better revision makes last month not look as bad. But again, it just shows you how shy the ONS is at the moment in producing data. Elsewhere, we got earnings coming in round about expectations. Ex-bonus was a pip higher than expected, but still down 3, although that was a high revision as well. Including bonuses came in as expected at 5%. Again, that's down, but again, we saw higher revisions in last month's payment numbers as well. And the 3-month rolling employment change also looking better, 134,000 versus 46 expected. Again, we saw, though, the unemployment rate ticking up to 4.7%. So the data is a little bit messy, in my opinion. Again, it doesn't scream that the BOE should be rushing into cuts. Yes, we're seeing some weakness, as Mr. Brown pointed out. That's the 8th month on the trot where we've seen a drop in payrolled employees. So there is weakness there, but wages are still very sticky, and we're not seeing an outright collapse in the jobs market. So same question, Kay. Does this push the Bank of England over the line for a rate cut, or does that CPI data early in the week keep them sitting on their hands?
On their hands, for what I'm concerned. They can hide behind the revisions, but and I'm always saying this. I mean, the Bank of England is and then Bailey on the lead can be can be a little bit unpredictable, and all of a sudden leaning towards the dovish side. Although they have more hawkish members than they ever had, I think, in the Bank of England, because they usually before used to be a very miserable bunch, but now there's probably enough votes to keep it the hands still. Um, yeah, I mean that those as you say, I mean the thing is those revisions, and it's hard to bank on any number, and but let's say let's take it all for face value. Unemployment rate, as you're showing there, is ticking up a bit, but I wouldn't say that's enough to get them over the line. No, I think it's still a sitting on hands report. Yeah, that's what I'm thinking about it anyway.
Yeah, I mean, looking at that one, it does look a bit of a steeper trend than
Yeah.
what we're looking at in the Aussie, and maybe they'll want to act so it doesn't balloon higher and we start getting unemployment at 6% or something. But then they've got to consider that inflation, and as I've been saying, further public sector pay deals coming through. Strikes, which likely going to lead to higher pay deals in the public sector. There's still plenty of factors pointing to why they shouldn't act on inflation rather than should act on the economy. But it's a conundrum for them.
Where's the Bank of England in their rolling off of their gilt buying stuff? Because I kind of lost track about it.
I think that's coming up in 2026, if I'm not mistaken, when they're going to decide what they're going to do with QT.
Because I have this theory I've been toying with for quite a while now, and because I'm continuously saying that those central banks would hate to have to raise rates because of inflation. Would they not rather step in and buy some of those bonds again, just to try and calm down those yield markets or the bond markets if we get drops on higher inflation prints? I know it's not an ideal situation, because if you start to buy bonds, watering down of stuff, but rather than having to react to inflation, I'm still thinking that there is a fair chance that the major central banks are rather going to buy bonds than hike rates on the back of inflation, but will cut rates faster if the jobs market is looking bleaker. And we may be in this kind of situation because the chart you're just showing is showing a clear uptrend in the UK, and then we are facing with our crying chancellor as well.
Yeah, exactly. So you reckon we could get a bit of QTQE?
Well, yeah.
We'll keep that one in reserve. You'll be seeing that in Bloomberg presses and Reuters later. QTQE.
Oh, if they publish that, then we know that they are listening to our show, right?
Yeah, exactly. They should be. Talk more sense than they do. Anyway, hello, Mr. Bailey, if you're listening. Right, we also had BOE's man who said yesterday before the inflation data, or said before the inflation data, that inflation had been coming down quite a bit and doing quite a bit. Now, she believes it's going to take some effort to get inflation down after the prior numbers. No shit, Sherlock. Bundesbank was out with their latest report saying Germany's economy likely stagnated in the second quarter. Again, no shit, Sherlock, for that comment. Finance Ministry said they expect economic growth in the second half of the year with approved government measures. So we'll see if all this sofa spending is going to get the German economy ticking higher. It is possible. We've seen a little bit of a pickup over there. Late summer green shoots, we should call it. Let's hope they don't die off in the winter. You don't need the ECB to cut rates in the Eurozone. Bank of France has cut its Livret savings rate to 1.7% from 2.4%. This is a special savings scheme that they run in France. But they decided to cut 7 pips off the rate there. You can work out why. The economy is not exactly doing well. Puts a bit back into trying to get the economy moving. We've got this European budget crap going on. It was all announced to a big fanfare by von der Leyen yesterday. They've got another 400 billion crisis mechanism, or one of the other crisis mechanisms that they've got going is going to be included in the new EU budget. And she says the financing of the new budget is going to use new revenue sources, meaning that national contributions will remain stable. I'm going to give you this one, Kay. What new revenue sources can they dream up? They can't make the old revenue sources make money.
Tariff the US. Raise tariffs on the US. That's a good question. The new revenues, I think they are hoping that all those rebuilding plans by the individual countries are going to line the local companies' pockets, and from there they will get more money from their gains. So I guess that's what they're kind of banking on. I don't see too much where they could get other revenue, because as we know, the consumer is already stretched like everywhere. So I don't think that they can get more money out of there. What they could do is, but that's going to be extremely unpopular, is doing what Beirut is planning to do, and cancel a couple of holidays to try and get the productivity up. But yeah, I really don't know where else they would get the money from. It's a bit strange though, because Germany voted against the long-term plan, right? The 2028 whatever 7-year budget, but
Yeah.
they themselves are putting like heaps of money into restructuring, etc. But von der Leyen, part of this extra money is for competitiveness, increasing competitiveness of European companies, etc. And I don't see why well, I can see why, because Germany is the biggest contributor. So they don't want to pay over the top of what they are already budgeting themselves. But yeah, increasing competitiveness wouldn't be a bad thing for Europe, as Mr. Diamond himself said a couple of days ago.
Yeah, and von der Leyen also dropped a line in that fiscal responsibility, budget rules will still be in effect for all the countries, for countries who have been flouting budget rules since the get-go, really, deficit rules and everything like that. But apparently she's going to be strict with the rules on that. It didn't take long, obviously, for many parties to come out, European parties to come out saying they don't agree with the budget and won't vote for it. So this bum fight is to continue. This budget is for the 2028-2034 period. So we should get an answer or an agreement on that budget around 2050. Citigroup expects ECB to cut rates in September and December, after thinking they were going to cut in July and September. So another bank forecast out the window, and a new one fresh on the typewriter. A bit of data yesterday from the US. We got PPI numbers, which came in a bit softer than expected, 2.3% on the headline versus 2.5%, 2.6% in the core versus 2.7% expected. Both of those down on last month. Not huge moves. As we've been saying, PPI is a bit more of a volatile beast, but it did suck a bit out of the CPI moves that we saw previously earlier in the week. Those numbers being a bit softer because some of those components do feed through into the PCE data. So the market just seeing a little bit of a softer inflationary impact with that. But again, as Mr. Brown highlighted from Dario Perkins, PPI data doesn't contain some of the potential inflationary aspects that we might see from tariffs like CPI does. It's a bit of a lag, and certain components like import prices missing from that. But who knows? It's all a big mess at the moment. Anyway, industrial production a bit later was looking a bit better, 0.3%, manufacturing 0.1%, capacity utilization ticking up to 77.6%. So all looking tickety-boo over there. Kate, another question I want to ask, we've been talking about this morning and with bond markets and everything else. For all the noise and the headlines and the Trump stuff and tariffs and Powell and all that sort of stuff, we still got to keep in mind the fundamental picture and the differences between different countries. Because I assume at some point we'll get back to trading the fundamentals one day when we're not jumping through out of frying pans into the fire. And this data just sort of proves that, we're not seeing, again, hard data collapsing or showing any major weakness.
Yeah, absolutely. I think it's part of the latest moves that we've seen as well. The dollar is doing better. But, whoops, what is it? Oh, here we go. Hang on a minute.
Refreshed.
Okay. Yeah, so that's part of the latest moves, and yeah, we have to take them into account. Now, historically, the U.S. Economy is sorry, more dynamic than the European, for instance. In Europe, although we have seen accelerations in all those economic cycles since the pandemic, Europe is typically a slower mover, and so that means that I think the market is still in the longer termers are still in with this in the back of their mind, saying that if something would turn around in the U.S. Economy, it's probably going to go faster than in Europe, i.e., you get faster growth, but also a faster decline in growth is possible, and I think that's where kind of or part of the thinking of the longer term is saying that, well, okay, Trump is putting all of this in danger. We may not see it immediately in the numbers, but we think that in the meantime we are already second half and well underway. Well, a bit underway, but the long termers are thinking that this whole picture is going to change second half of the year. Now, is it going to be another 2023, another 2024, where the market will be wrong and the US economy continues to defy the laws of gravity? That is going to gradually filter through. And I guess that the problem is that all those tariff lines and the impact then of them as well are getting delayed and delayed. You get a 90 days, then you get another extension, and then you probably the 1st of August will be extended again. So all that impact or the expected impact on the US economy is likely getting delayed and delayed. But yeah, but as you say, for as long as the US economy holds these levels, which are, let's face them, still pretty healthy, 4.2 or whatever, 4.1 unemployment, and you're still looking at half decent growth compared to anywhere else, basically, especially if you look at Europe, the UK, for instance. Yeah, I mean, it is a fact that it's hard to justify, at least in the shorter term, a short dollar position right now.
Yeah, very much so. It's as we've been saying for a while. We trade in layers. There's different layers that we trade at any one time. Last week trading tariff deadline trade. This week started trading geopolitics and the conflict in Russia. Then you got Trump stuff about Powell, and then you got something else, and you have to keep in mind the fundamentals underneath. Okay, they are constant. Okay, trading tariff deadlines, it's a short-term thing. The fundamentals remain underneath. So you've got to keep your finger on the pulse of the fundamentals, because if we get through all these short-term events and market moving things, we will go back to the fundamentals. I mean, we've talked about it before, okay, the trading now, I've never known such a bonkers market at the moment. In normal times, you're trading the fundamentals and what a central bank's going to do, and that's about it. And maybe there's an odd sprinkling of politics now and again. But I don't know what we're trading today. I don't know if we're trading Powell. I don't know if we're trading tariffs. I don't know if we're trading fundamentals. I don't know what we're trading.
No.
And that's the difficulty at the moment.
Yeah, we're not trading Powell until 5 p.m. UK.
No, obviously, but
No,
you
but
get what I mean.
that is a fact, right? If you see a percent move on what happened yesterday again, but no, that's what we were saying. I mean, we are in there's so much going on that it's very hard to justify a position for more than a number of days. We used to have position. Well, I mean, there was
4 minutes
decent
yesterday.
move. But we had it. We had this decent move, but now I think we are in. The dollar is correcting. I think on the back of some kind of fundamentals. But then, if you look at the other side of any dollar pair, you're trading different stuff, different currencies as well. Yeah, the yen is really struggling with the due to the elections, due to the trade deal. Canada is struggling because they don't know either at which source they're going to be eaten. Then you have the euro, which is also you're waiting for a potential deal or no deal. But in the meantime, the euro growth is still extremely anemic. So and I think that is what we are trading now. I think we're now in effect that the first big move post Trump's inauguration has been done. That is kind of clear. We've had this, and for people who were listening to the last face show of last year, Blake asked us what we thought about 2025, and that's what I said. I mean, the dollar's going to be bid until Trump's inauguration day, and then it's going to probably go lower, and that is what happened. But we also saw, for instance, if you look at May, June, we have seen those kind of retracements as well in the market. The market is not going to go one-way ticket all the time, right? And we are now in one of those situations again where fundamentals are coming a bit back. So the dollar is doing a little bit better. There's also if you sell a currency for 10% on the basis of something, we are not talking about Turkey here, which has an incredible problems all around. We're talking about the US, right? And that's why it's good to look at data, but not only like employment or growth or whatever, but look at what the IMF data told us. And I suspect in Q2 it's not too much different. Everybody's always crying about the dollar losing its reserve status. The dollar part in central bank reserves over Q1 of this year has changed 0.3 or 0.5%, which is basically nothing in volume terms. It means a lot because I mean there's a heap of dollars in global central bank reserves, but I mean in percentage wise, it's not that the dollar is losing its reserve status. No way, Jose. So at one stage, you're going to have like people managing their positions. All right, we've wrote it for maybe not even 10%, but you start to buy on the break of 108, and then you buy more on that big break of 110, whatever. When it comes to 117, 118, everybody knew that 117 and a half was a big level. You overshoot, you don't hold it anymore, you try it again, you don't hold it anymore, you start to manage your positions a little bit because you do have decent profits in the books. And I think we are in this period right now where we need to wait what's happening. And in the meantime, as you say, the fundamentals in the US are still looking better than what is going on in the UK, in Europe, and even in big parts of like Japan as well. So that is what we are seeing now. Down to where we can, or up to where we can correct in the dollar, I don't really have a clear view on that one right now, and that's why we've been talking about that. We have to take everything day by day, right?
Yeah, absolutely.
And Mike, you're talking about the would you be long dollars? Who would be long dollars with the risk of the Trump dropping the Powell bomb? I think we've dropped already. He's dropped already enough bombs. I was saying in the room as well. He's probably going to go on a daily rant against Powell. But now, yesterday, we saw why after what is it, half an hour or something like that, he came up with, "Oh, I won't sack Powell unless there is fraud." So everything turns now around this review of the Fed's headquarters refurbishment, and that is now the only reason he could use to potentially go to court and try to sack Powell. That review, we don't know, first of all, when it's going to end, and secondly, if you take it to court and before it arrives at the what is it, like the Supreme Court, Powell is probably already at the end of his term in May. So I think the effect now of those Powell bombs is going to wane unless he of course says, okay, I'm taking it to court. Then we are probably going to see a reaction as well. But again, as we saw from Williams yesterday, and he's one of the main guys I am looking at to see if he changes tack or not. He still says that they are in a place where they want to be. So there's not too many rebels in at the Fed yet, at the FOMC at least.
Yeah, and Devesh is saying all this, it knocks our confidence when we're seeing crazy markets. Yeah, we may get to the end of it sometime, Devesh, but we've got to try and trade it in the meantime, and that's why we've been banging on about how you trade these markets. You've got to adjust to conditions. You know, don't be shooting for the jackpot trades. I'd rather catch 100 tiddlers than catch nothing going for the big fish or get my arm bitten off. You can make money just making small profits, you know, and if they're there, you take them, because if you get stung by something like that yesterday, you know, you can't do anything about it. And if you're on the right side of it, you take it, the money, when it's there. But anyway, let's crack on, because I've still got a few more bits and pieces to go through. So yeah, we had the Trump stuff, and it was a real shit show yesterday. CBS dropped the original bomb, saying that Trump had a meeting with lawmakers and that and asking if he should fire Powell, which people in the room apparently voiced their approval, to which some sources said Trump indicated he will do it. Then obviously we got every other news outlet trying to speak to someone, throw their own version out, repeating it. At one point, apparently, according to New York Times, he was waving a draft firing letter to all those at that meeting. Bloomberg doing their bit as usual, saying White House officials said Trump was likely to fire Powell soon. That gave us another kick lower in the dollar, because it made it sound like actual officials were behind it. And then Reuters reported what Bloomberg said and claimed it as their own sources. So all that mess went on. And then Trump came out directly and pretty much dismissed it all. He started saying Powell does a terrible job, but we will fight through it. And then he's not planning to do anything on Powell because we need to get a change in 8 months' time. And then he was asked about firing Powell, said they're not talking about it, and that firing Powell is highly unlikely unless there is fraud. So what Kay said, it's all going on this renovations thing. And that he hadn't drafted a letter to fire Powell, but saying he raised the concept of firing Powell with all these people in the room. So a real shit show in markets yesterday, as you can imagine, particularly in the dollar and the dollar yen, all over the place on that one. Massive fall down to 147 from up near 149s. And then we're all the way back again. Now, one thing I want to say about the central bankers, Kay, we had Bostic first. He says he tries not to focus on news reports about the Fed, but on things that actually matter. Williams was waffling on about tariff impacts and whatnot, but saying that rates are okay where they are. But he said he was asked about Powell, and he said he can't comment on the Powell firing stories, and that Fed officials and staff maintain a laser-like focus on our mission. So the question I want to ask, Kate, is it me, or is Powell not getting any vocal support from any of the other Fed heads? No one's stepping up and saying, you know, these attacks on the Fed independence and on Powell are above, you know, over the line, and they should stop. Is that something we should be thinking about?
I think it's protecting your own chair in a way. We've been chatting about Michael Brown in the newsroom the day before yesterday, trying to think outside of the box, and looking at who is going to be renewed, or deciding on whether Fed governors keep their seat in the next year or so, year and a half, and we have we have to remind us that the Republicans have won the election. So there's a lot of local governments who are Republican right now, right? So anyone who steps too much into the support for Powell right now risks losing his or her seat, you know. And I think two like Bowman and what's the
Waller.
other? Waller, yeah. They have noticed that very quickly. I think there's a bit of seat protection there, but they have to. You sometimes have to stay neutral. They all are behind the central bank independence. That is, I think, quite clear still. Now, the problem is for them, if they take Powell's side, they are going to be bombarded by the whole Trump administration, Trump in the lead, every day as well, and then the Republicans, they are going to start shouting louder and louder. So I think there's a bit of a case of like either protecting their own seat, or trying not to stir the shit too much right now. Let's let it all play out and then see what there is to be done. But I think their support for the Fed's independence is unchanged, but I think it's a bit psychological. You can't really say too much right now. And perhaps, behind closed doors at the FOMC, there has been, and there must have been, a discussion around, and they all agreed, saying like, okay, let's keep this one quiet, because the more we stir the shit, the harder it's going to get. So I'm more signing on that side of the I mean, just the speculation what we can have.
Yeah, thanks, mate. Elizabeth Warren piped up saying that the Fed chair candidate shouldn't be from the Trump admin. No shock and surprise to that. Right, that's it from the headlines. Oh, blimey, clock's ticking on. Right, I'm going to give you a quick whistle-stop tour of a couple of things, literally 30 seconds, and then I'll give it to Mr. K. Dollar yen, we need to watch what happens again up at this 149. I'm a bit long, jumped in over the news yesterday. We've got this Besant stuff, Japan stuff. We've got the election coming up. I want it to be a bit long or a bit short yen, which I am. So I might run that, see how the rest of the week unfolds before deciding what to do on the weekend. Aussie Kiwi, I'm just had a little nibble while Kay was speaking long here, just on this level here. It's had a knockback, but it was moving pretty strongly before that. So I'm just giving this a little tight one here, long off this level. Aussie dollar as well. A few people in the room got key levels around 80, this level here, 64.60s. Mine is down at this old 64.40.45, and it's matching up with that trend line as well. So I'm going to keep a bit of an eye on that one. And euro sterling having a little pullback, just tapping the bottom of the zone here. So I'm keeping an eye on that one, because I still fancy getting in on a little dip, but whether I want to do it here or see if it runs through to 86s, 86.20s, try and get a better price. That's it, Kate. I'm bringing it over to you, mate.
Yeah, I agree on the Aussie, by the way. I've got also 40s and 20s as well, somewhere around 64 and a quarter, 64.30. Hang on, what am I looking at? Oh yeah, cable. Yeah, that one's an interesting one for the short termers. If you look at this cable, um, 130, 133 three quarters. Look at that. We did bit of a low there in June, and now we've tried it already a number of times, and it continues to show up. It's also been it's also somewhere this zone here is a half decent fib zone as well. So don't dismiss this 133 three quarters because we are bouncing off it, and I'm actually thinking it may have to do something with euro sterling as well, as Ryan was saying in the room earlier as well. Oh, we're here on this 86 and a half, but I'm not sure I want to buy it here. Well, I was long euro sterling, but yesterday I cut it. Then I tried it again this morning, but I had the same feeling on euro sterling. I don't particularly fancy it right here and now. I want to see what's going on with the euro and the sterling side at the same time. But we have to respect this little level here, guys, around 133 three quarters. Obviously, if it comes down, then we have like another level here around 132 and 132 and a half. 132 and a half. That's a percent away. Okay, it's a 4 hour, right? A lot of short termers will find levels in between 133.30, 132, 133 the figure, which will be one, I think. But the main one under here is only going to show up to me around 132 and a half. And what are the numbers that we have today? Jobless claims, Philly Fed, maybe, although I mean jobless claims. Okay. Um, but if the dollar catches another bit this afternoon, and we break down here, it could be a bit of an accelerator, okay? But for as long as it holds, respect that level. Yesterday that blip higher, and we have to look at where those blip stops are stopped. Yesterday that blip stopped around this 23.6 in the 134.70s. That's going to be the hurdle of the day if cable continues to recover or if the dollar starts to falter once more. I think if we get more Trump lines without Trump saying that he is de facto going to go to court for Powell, I think personally it's far too early. But then we could push higher. But I still think that any bounces here are going to be met with sellers. Same thing on the euro. Euro is looking a bit fragile, in my opinion, for as long as we stay now. Okay, we had this blip, but assuming there is not much more going on, anywhere up to 116, 40, 50, it should be capped again, in my opinion, right now in the very short term. And there is a possibility that we're going to have a look at low 115s unless as I said, we get like very negative news on the dollar. Metals, not a lot to say. Yes, we're coming back down, but look at what happened on the Trump Powell blip. We briefly spiked above. The nature of the spike was very, very fast, but we didn't hold 33.70, 75 in gold. Same thing on the downside. 33.20, 25 we are holding. So the gold market is trying to keep a cool head in all of this. Obviously, there's going to be bigger supports lower down, but for the time being, we are being kept in this range for now. The trend line is starting to come too close to market for comfort for me. Yeah, people will be looking at it and maybe even saying like, "Oh, look, it's breaking." But then look at what happened here. We had like much bigger moves and still rebounded quite fiercely. For me, the real level is going to be again 32.85, 32.90. Okay, that I think is a much bigger level now because I don't like it when those steep trend lines come to market instead of the market going to the trend line. Okay, and top side, very clear and clean. We need to break above this 70.75 to go up into the 34s. I've got tiny bits and pieces, as I said earlier in the show. It's been a 0 day has turned into a decent day, because yesterday I managed to sell most of my gold that I picked up around 33.25 and 35. I managed to sell it around 33.70, so I'm quite happy. I've got like little tiny bits and pieces left over, but I'm looking to see if we get down here to perhaps load up more silver unchanged. I'm still trying to get some around 37.30, 36.80, but is it turning into a story just above 35 and we are never going to get there? I don't know. Let's see what happens this afternoon. And all the currencies look pretty much the same, right? Better for the dollar. And Kiwi here is no exception. We are getting closer to channel support, okay? Low 59s, we are not too far away from it. Trading 59.15 right now. A bit of a dangerous situation, yeah? We are seeing the dollar just slowly creeping up again. I think there's a bit of a danger. We are going for a little bit of a look lower before anything else, and more data perhaps to show us the way in the dollar. But it does look that the dollar is still a bit better supported, so I would not rule this one out. And with that, Ryan, looking at the clock as well, I give it back to you, mate, for today.
Yeah, thanks, mate. Good show, busy show. I hope we're keeping you all well informed on these shows. And, if you have any feedback or anything general then about the show, let us know. Where you can contact us in the chat room or on the socials. So we're always happy to take your feedback. Right, let's see what today brings. Take care, everybody. Have a safe one, and we'll see you all tomorrow.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.